Launching a massive product today takes billions of dollars in upfront cash. But rewind to the 1600s, and the Dutch East India Company faced a very similar hurdle. They needed to send hundreds of heavy wooden ships around the globe to trade gold, spices, and silk. Expanding a business on a global scale requires an immense amount of capital. A company could try to borrow all that cash from traditional banks, but taking on that much debt is restrictive and dangerous. If a few ships sank in a storm, the entire enterprise could go bankrupt under the weight of the loans. To survive, the company had to look past the banks. They needed a way to attract funding directly from everyday private citizens. The solution they found was incredibly effective. The company offered regular people the opportunity to use their personal savings to help fund the expensive voyages. We can see exactly how this trade-off works in this diagram. A company takes the total pie of its ownership and slices it into hundreds of tiny slivers. When an individual contributes their own money into the center, they receive one of these pieces, known as a share. The Dutch began selling these profit-sharing agreements in shipping ports and coffee houses across the continent. In doing so, they unknowingly created the world's first stock market. Instead of a single wealthy owner taking on all the financial danger, regular people could absorb a tiny fraction of the risk in exchange for a slice of the eventual reward. Fast forward to today, and the process is heavily regulated. When a new business wants to raise money on the public market, it goes through an initial public offering, or IPO. An IPO officially lists the company's shares on a major stock exchange, publicly opening the doors for anyone who believes the business will be profitable to buy in. You can find these massive centralized marketplaces operating all over the world, heavily trading on platforms like the National Stock Exchange and the Bombay Stock Exchange in India. Buying a stock through one of these official channels means you are buying literal ownership in that business. Your personal wealth becomes directly tied to the company's real-world success. So, once you actually own a piece of a business, how do you see a return on your money? This chart illustrates price growth. Buy a share at 100 rupees, and as demand increases, the price pushes to 150. You can sell for a profit. Or notice these coins dropping along the timeline? A dividend. Profitable companies regularly distribute earnings directly into your account. Whether you sell a valuable stock at a premium or hold on to it to collect regular dividends, your investment grows right alongside the company's expansion. Of course, if a company's success drives your share price up, we have to look at what forces cause investors to lose money. Businesses are constantly exposed to external pressures they cannot control. A sudden change in trade laws, fluctuating material costs, or unexpected shifts in leadership can completely stall an organization's momentum. When bad news hits, human emotion takes over. Worried investors will rush to sell their shares quickly, hoping to get out before the company loses more value. We can picture this relationship on a seesaw. As investors panic and sell, the supply side gets top-heavy. That sudden oversupply destroys demand, pushing the stock price steeply down into the red. Daily stock prices measure human psychology more than simple math, turning every ticker into a real-time thermometer for collective confidence and fear. Because human emotion is unpredictable, treating the stock market like a casino where you try to make quick cash frequently ends in massive losses. Financial professionals rely on a much simpler approach. Patient, long-term investing allows your money to grow steadily and outlast the daily noise of market panic. If you are ready to participate, the rules are straightforward. Take the time to learn how the system works. Start with a small amount of capital and target fundamentally strong companies. You can protect yourself further by using the strategy shown here, diversification. Instead of putting all your cash into a single risk, you can split your investments into a multicolored pie chart across several different industries. If one sector fails, the others help keep your total portfolio balanced. True wealth in this system comes from holding steady, calculated ownership over years, rather than reacting to the daily anxiety of the crowd. For a very long time, participating in this system was largely restricted to a wealthy elite. That is no longer true. The physical barriers to entry, like shouting across loud exchange floors or reading paper tape from an antique ticker machine, have been entirely replaced by software. The internet and modern mobile applications have placed the full power of the global stock exchange directly into the pockets of everyday investors. Anyone with a smartphone can educate themselves, download a trusted brokerage app, and start buying shares today. A financial structure designed hundreds of years ago to keep heavy wooden ships afloat now serves as an accessible tool for ordinary people to build their own financial independence.